Hello, my name is Dino Hoss, and today I will be explaining the formula used to put together the balance sheet. The basic principle covered in a previous tutorial on the accounting equation suggests that the money that is spent by the business has to equal where the money came from. And we know that every business will have a set of resources such as land and buildings and machinery, motor vehicles, and the money that's used to pay for all those assets or resources used to run the company has to have come either from liabilities, money borrowed from outside the business, or the actual capital that's invested by the owners of the company. Therefore, we know that the assets used by the company are always paid for by money invested in the form of capital by the owners or the shareholders, or money borrowed from outside sources such as a bank. So we know mathematically that assets are equal to capital plus liabilities, and we split the assets into two types, which we will go through in another tutorial. So the assets themselves are split into fixed assets, sometimes also known as non-current assets, and current assets. Fixed assets basically are long-term assets such as your motor vehicle, your land, your buildings, in other words assets which are expected to last more than a year, and the current assets are those assets that are changing on a day-to-day basis within the financial year. And the formula stays the same on the right-hand side. It's equal to capital, which we'll denote with a C, plus liabilities. The fixed assets, if we denote that as FA, and we add it to our current assets on the left-hand side of the formula, is equal to capital plus we divide the liabilities into current liabilities plus non-current or long-term liabilities. And then the balance sheet simply rearranges this formula, and that is the layout that you will study in the next few tutorials. So if we rearrange this formula mathematically, your fixed assets plus your current assets, and we bring the current liabilities over the bridge, so it becomes minus current liabilities minus long-term liabilities is equal to the capital that's invested by the owner. Thanks for listening. If you found this tutorial useful, then please do wait around for the next tutorial to load up in the playlist. Remember, you can always subscribe to our YouTube channel, and if you did find this tutorial helpful, then please press the like button.